Hi! In the first video on equity investments, we said that publicly listed companies, that is those companies that have their stock trading on public stock market exchanges, were once privately held companies that transition from privately owned equity to public equity after holding an initial public offering or IPO. We also said that this doesn't mean that being a public company is a desired state. There are certain advantages and disadvantages, and companies make their decision as regards going public or not after taking them into account. Here we will have a discussion on those advantages and disadvantages. Before jumping into them, I'd like to say that if I had named this video Public versus Private Equity, it'd still be a suitable name. After that note, let's jump right away into the advantages of being a public company as opposed to being a private one. It opens up a broader investor base for fundraising. When the company goes public through an IPO, the pool of potential investors significantly increases. Previously, the company could only attract capital from private investors. Now it can still do that, but it can additionally tap into funds from the general public. Writing this is redundant, as private investors are a subset of the general public. Still, I want to make it perfectly clear that private investors are not excluded from investing in public companies. Moving on, an IPO usually results in a significant cash infusion. This cash can allow the company to pursue profitable opportunities it couldn't before due to lack of funds. Furthermore, being public makes further capital raising easier in case the company decides to yet again attract funds from public markets in the future. The reason for this has to do with the fact that when you go public, you have to comply with certain reporting and regulatory requirements. This compliance makes the process for capital raising in the future both less costly and less time consuming. And the process is easier not just for future equity financing, but also for debt financing through issuing bonds. So overall, the company has greater ability to raise capital. Additionally, being a public company can increase the company's credibility. In the previous point, we mentioned that going public involves meeting certain reporting and regulatory requirements. This includes making certain disclosures and thus entails a higher degree of transparency on behalf of the company. All these have the potential to increase the company's credibility. Now, in case you are wondering how does improved credibility help the company in monetary terms, a more credible company can more cheaply raise capital from both debt and equity markets, which takes us back to our previous point. So these 2 points are connected. On to our next point, being public can offer potential marketing advantages. That's because public companies generally get a lot of coverage from financial news media, especially during the IPO process. This publicity can enhance the company's competitive position, its recognition in the marketplace, and can have other positive effects as well. For example, the status that the company will now have might allow it to better attract talented employees. And having talented employees is one of the most important factors for the company's long-term growth. So far, this discussion has been revolving around the advantages or potential advantages of going public from the company's perspective. We will now see the advantages from an investor's or shareholder's perspective. When a company's stock trades in public markets, it makes it easier for shareholders to liquidate their holdings by selling their shares or increase their stakes in a company by purchasing more shares. All you need to do is contact your broker and place your position. Things are not as simple in the case of private companies. In addition to that, for publicly traded stocks, there is an established market price that reflects market consensus. So the market in its collective wisdom assigns a value to the company's stock. This reduces uncertainty about value for investors or potential investors. But there's a caveat to this second point, as there are periods when the market behaves irrationally and stock prices do not reflect the fair value based on fundamentals. This can lead to the creation of stock market bubbles. In general though, in developed markets, we can expect the stock price to reflect the fair value based on fundamentals. And we will get to company fundamentals as we progress. But to give you an idea, one such fundamental is corporate earnings. That's why when a company announces its earnings, you can typically see a jump in the stock price if those earnings exceeded market expectations, or equivalently a fall if they were below market estimates. Let's continue with the disadvantages in the next video.